participants, you can ask questions if there are any doubts from last session. So if there's any student who want to ask questions, sir can answer you. You can type your question in a chat box, in the question answer box, and sir will answer you. अथर्व ऐक ना, मी काय बोलतो, मी पप्पांना आता हे देतो, मी राईट्स होस्ट को होस्ट देतो, नंतर होस्ट देतो मला. आणि बंद करताना सर त्या फक्त स्टॉप लाईव्ह स्ट्रीम कर आणि मग एंड मीटिंग फॉर ऑल करायचं. आणि मी काय बोलतो, आता सध्या ना पार्टिसिपेंट्स कोणी रेज केला असेल ना हँड, त्यांना फक्त हे विचार, एका कोणातरी हे केलंय, हँड रेज केला वाटतं, नाही लो लो केला वाटतं, ते फक्त ते बघून घेशील तसं. चालेल, ओके. मी दिलं पप्पांना होस्टचे राईट दिले. एकदा सेशन स्टार्ट झाला की मी होस्टचे पण राईट देऊन टाकतो. नाही ते काम करतो, मी होस्टचे राईट देतो. ऐक मी होस्टचे राईट देतो, मला फक्त को होस्ट दे. ओके चल, युअर होस्ट ना. चल ठीक आहे, बाय.
Good evening to all the participants. Today is our second session of this miscellaneous insurance. Yesterday, we have acquainted with some of the policies of miscellaneous insurance, and today we will be beginning with what we have left yesterday. First, to introduce myself once again, I am Kaustup Kulkarni, Divisional Manager from the New India Assurance Company Limited at Chembur Divisional Office under Mumbai Regional Office 5. This is a training session on miscellaneous insurance for all of you who are giving exam under para 13.2. This is a good opportunity for all of you to have a good marks, and with a great success, the promotional opportunity is with you, and this opportunity is given to you by the companies, and for that we are here to give you the training with the help of Bharatiya Bima Karmachari Sena in association with Insurance Institute of India. So we'll start today's session. Yesterday we have learned personal accident, the policies under personal accidents, the group personal accident, the student safety policy, and all features and coverage and exclusions we learned yesterday. Yesterday we have started the session with burglary policy. Am I audible to all? Am I audible to all? Okay, thank you. We'll start today the burglary insurance policy. Yesterday we have covered the coverages, what burglary policy is all about. Today we'll start with the rating part, and after the rating part there are many of the burglary policies which are there, which we should know. We should be acquainted with all those burglary policies, and according to our examination point of view, some key points to note while appearing in this examination. So we'll start today's session of miscellaneous insurance, and to start with the burglary insurance. Today's first screen, I am sharing with you the first screen of today's miscellaneous insurance, that is burglary insurance, wherein the rating part is in front of you. As you know, this is a non-tariff business. You all must be knowing what is tariff, what is non-tariff. Tariff means wherever there is a business which is governed by the tariff, it is called as the tariff business. There is tariff, like in a motor, there is India motor tariff. In fire, there is AIFT, All India Fire Tariff. So these are the tariff businesses, whereas burglary insurance comes under non-tariff business. So the rating is non-tariff business. Non-tariff meaning the rating part is dependent on the company as a whole. The company will decide the rating for the burglary policy. The rates, there are no fixed rates. In tariff business, the rates are fixed. In tariff business, the coverages, the exclusions, all parts are fixed. In non-tariff business, though there may be the coverages which are fixed, but the ratings are not fixed. The rating may vary, and according to the business, according to their loss ratio, according to their degree of hazard, you can quote the premium, you can quote the rate. So this is a non-tariff business. Second one, the premium rates depend upon the client. See, now here the premium rates depend upon clients means it's not that the client will give you the rate, but it is upon the moral hazard, the degree of risk which is there associated with the properties of the client, and according to the degree of hazard and the moral hazard of the client, the premium rates are dependent. Please note that the premium rates, when they are dependent on client, it doesn't mean that client is giving us the rates. No, the premium rates depend on the degree of risk, degree of hazard associated with the properties of the client and the moral hazard of the client. See, to understand, burglary insurance is available, and as a prudent underwriter, we should give the burglary policy to the clients which are on your books, who are giving a good sizable premium with higher degree of good moral hazard. Then only we are issuing the burglary policies. Third, situation of risk. See, situation of risk is one of the most important factor in the rating of the premium for the burglary insurance. Situation of the risk in isolated area. Suppose the business premises is in such an isolated area that within certain parameters of the area, there are no factories, there are no residential area, or the movement is very minimal or less. Then in that case, the degree of hazard is more, because the risk which is situated is a alone risk. You may say that the surrounding properties or the surrounding area is minimal. There are no factories, there are no residential, wherein there will be ward and watch every time, not only by the owner or the entrepreneur, but also by the common public. So in this case, the degree of hazard is more dangerous, so the rating will be high. But suppose a reverse case, if the burglary premises are located in a industrial estate, in the industrial area, where the compound wall adjacent to the compound wall of the business entrepreneur, where you have given a burglary policy, next to that, there is the east, west, north, south, there are certain factories, there are the shops, there are some certain hotels, or if these are the situation of the risk, the location of the risk, then the degree of hazard or the burglary hazard will be lesser. So in that case, you can rate a good premium. That is, a sizable discount can be offered. Then the property to be covered. See, property to be covered is very important. The property which is of high value and which is of very small thing, like the medical equipment. If a medical equipment is in a cartoon box and it has a value of say 10 lakhs, that medical box in that medical equipment, that medical equipment in the box in a factory, it can be easily burgled. So this property will be considered as a high risk property. Exactly reverse case, if the food grains, the sugar factories, wherein the sugar in bulk is stored and which is in a big, there is ample of sugar stored in the godown or in the factory premises, which is in loose. So in that thing, the sugar cannot be burgled or stolen. So this property can be considered as a good risk. So these are certain parameters which we should ought to know while rating the burglary policy. Next is the precautions for protection. As you all know, burglary policy, there has to be some protection by way of the watchman, by way of the CCTV, by way of the burglar alarm. So which are the actual precautions taken by the business owner? He, according to the precautions taken for the protection, we can allow certain discounts or we can give the good rate. The precautions can be for watchman, that is, there are certain categories in watchman also. Suppose a watchman is common watchman for say in a one industrial estate, or a separate watchman for a particular business. Then in that case, a separate watchman or the separate employee watchman for the business is a good degree of hazard, and it is, we consider it as a safe risk, because the 24/7, or if there are two watchmen in two shifts, then this protection is very well considered for allowing the discount. Accordingly, nowadays, since there are the CCTV cameras, the burglar alarm, wherein the alarm can be put in by the entrepreneur, and the nearby police station gets the knowledge of any burglary happening. So in that case, our risk is minimized. So these precautions for protections are the rating factor. Then next is previous claim experience. See, previous claims experience is very important. When I started today's our session, I told you that the burglary policy is to be issued for the valued client, or the client who are on our books giving us good sizable premium with a lesser incurred claim ratio. So if the previous claims experience is nil, say for example, last 3 years or last 5 years, there is no burglary at all in those premises, this will be considered as a good rating factor. And if the claim experience is bad, like the last year they have a claim experience, the burglary is there, the year before last year there was a burglary, there was dacoity in that premises, then these actually experience of the client is considered as a very bad claim experience. See, it is up to you, that is up to the insurance company to decide whether to allow the burglary policy to be continued or not. If you want to discontinue the burglary policy at the claims experience, a bad claims experience, then it is up to the insurance company to decide. So previous claims experience is very important. So as a good underwriter, these factors are to be considered while arriving at the premium part in the, by giving the rating structure. The last one is the higher or lower rates may be charged and protective measures imposed if felt necessary, considering the hazard involved. What this means? See, whenever you are offering any lower rates to the client, you may have some warranties imposed while issuing a burglary policy. These warranties or the conditions which is put by the insurance company, it is clearly written that suppose in a, you have issued any burglary policy and you have imposed a warranty stating that 24/7, that is for 24 hours and 7 days, that means for whole of the time there has to be a dedicated watchman or the security guard placed at the premises, then this warranty is very important. If there is any breach of warranty, then it is going to affect the claim. So these are the certain things, these are the certain protective measures which can be imposed if felt necessary, and wherein you can ask your client to have the necessary changes done. Suppose your client may have certain previous claims experience of burglary. You have to assess the situation and convey your client that yes, because of this factor, the burglary has happened. Now you are requested to correct that factor, and then only we can issue the policy. So the corrective measures are to be imposed. The corrective and protective measures are to be imposed. It is to be conveyed to the client. And after doing these necessary changes, the renewal of that burglary policy with the necessary rating structure is to be submitted to the client, and you can issue the policy. So this is the rating part in burglary policy. Furthermore, reduce rate, when I told you that you can give the discount or you can load the premium. So what are the things which we should consider while underwriting the premium part and offering the rating is that reduce rate for stocks in bulk with large sum insured. See, this is very simple to understand. Whenever there is a stock, there are the stocks which are in bulk. As I already told you that in sugar factories, the sugar in loose, when it is stored in a sugar factory, the chances of burglary for that stock is very minimum, because that sugar is in bulk and it is stored in that sugar factory as a loose component. So these large sum insured in bulk, or you may say the entrepreneur wherein having the heavy metal industry. You know, the heavy metal industry, the metal itself are having a capacity of very huge tonnage. Their weight is around say 10 tons, 100 tons or like that. So the chances of burglary for this high tonnage material is very, very less. So for that, you can reduce the rate. You can offer them the good discount. Whereas increase the rate, second one, increase the rate where chances of major loss in single incidence. What this means, as I said earlier, the medical equipment. Suppose a medical equipments which are very high value, say a medical equipments which is in a cartoon box or cardboard box, and that box can be easily lifted by a single person at any moment, or it can be burgled, it can be stolen by any of the burgled person or the burglar. Then there are chances of major loss, because the value, high value medical equipments are considered as a major loss in single incident. So in this case, the rate are to be increased. I kindly request all of you to please ask your questions in our chat column, so that I will be able to know your question, and then accordingly I can definitely give you the answer. I request you to ask questions in the chat box. Thank you. So these are certain things. Reduce the rate for stocks in bulk with large sum insured, and increase the rate where chances of major loss in single incidents. Cash oblique valuables in burglar proof safe. So if any cash or valuables are to be insured, are to be considered for insurance, then those are to be stored in burglar proof safe. See this, whenever we are saying burglar proof safe, so for a safe, there are certain dimension, there is certain weight which is prescribed, and accordingly the definition of the safe is considered. So if you want to cover the cash or valuables, then it should be kept in the burglar proof safe. And then the rating factor will be a good rating factor. Next comes the first loss. You must be aware of this nomenclature, first loss. What is this first loss? The percentage which is written over there, the 90%, the 50% of the premium is charged depending on percentage of sum insured opted. So this, what is this first loss and what is this premium chargeable? This will in a separate screenshot or the separate slide, I will be able to convey you, and you will be able to better understand. So first of all, just see that the first loss policy is a part of a burglary policy only. What is first loss policy? I will convey you when our next slide of first loss policy comes, and at that time I will be able to convey you all those things. The next, declaration policy, because the declaration policy and the first loss policy are some of the burglary policies where the rating factors are vary, and not the only burglary ratings are allowed. There are certain discounts, there are certain refunds, there are certain percentage of premiums are to be charged. So in the declaration policy, minimum retention of 35% at expiry as per fire tariff. But usually to now there is a retention of 50%. Usually the 50% retention is there. So the minimum retention 35% for declaration policy, but now usually 50% retention is there in declaration policy. See the underwriting considerations for burglary policy. Moral hazard of proposer. Survey of the moral hazard. I need not have to convey you, or you must have understood the moral hazard. The survey of the risk. Survey of the risk is the location is to be surveyed to know if it is the isolate location, or if the location is in a crowded area, or any other location. So the survey of the risk is a underwriting consideration. Maintaining of books of accounts. Maintaining of books of accounts is very important factor for burglary insurance. Nowadays, the books of accounts are maintained by generally all the business entrepreneur in a computer. So all the IT infrastructure is there, and maintaining of books of accounts is very easy nowadays. Previously, it was considered as a cumbersome factor, but nowadays all the IT infrastructure is there. So maintaining of books of accounts is now very easy due to the developments of computers. Regular stock taking and audit once a year. Again, the same thing, the regular stock taking has to be done by the business person. Along with that, if you are already issued a declaration policy, their monthly declaration has to be taken at first week, or this you say first day of the next month, to arrive at the stock sum insured per month. So this is regular stock taking. It is to be done by the business owner, and for a declaration policy, they have to submit it on the next month. Audit once a year. Yes, the audited trial balance, the audited balance sheets are done every year, and this is the underwriting consideration, because the moral hazard or the entrepreneur where the audits are done every year, these are considered as a good business entrepreneur, and our insured are considered as good insured, our valued insured, and we can offer the discounts or a good underwriting rating factors to arrive at their premium. Next is avoiding oblique loading premium for small articles with high values, that is jewelry, etc. Though I have given the example of jewelry, generally jewelry is not considered to be covered as a stock in burglary policy. For jewelry, as we all know, there is a certain policy, the jewelers block policy is allowed for those jewelers. So avoiding and loading in premium for small articles. See, if the value of particular small article which can be easily stolen, which can easily be, the theft can be easily done for the small articles with the high values, first of all, the underwriting consideration, you should avoid that. And if your client is valued client, then you have to load the premium. You have to load the premium, and accordingly you can give the rating factor. So this is important factor. This is important underwriting consideration to arrive at the premium. correct description of goods. Naturally, we should ought to know what are the goods, whether those are food grains, whether those are the heavy metals, whether those are the electronic goods, because according to the degree of hazard, the description after the description of the goods are received, you can very well assess the degree of hazard involved with the description of the goods. Next, the last one, separate sum insured for stock, cash, goods in trust. So, in burglary policy, you have to take a separate sum insured for stock, a separate sum insured for cash, and separate sum insured for goods held in trust. Yesterday only, we understood this concept, goods held in trust. Those are the goods which are not actually ownership goods of the business entrepreneur, but those are the goods which are there with the owner or the insured, which are belonging to their client, belonging to some other, which are kept in their custody for some job work, and accordingly the insurable interest of their client is involved. But suppose if there is any burglary to these goods which are held in trust with our client, then definitely the person whose goods are being stolen, the goods are being burgled, then for that person, they may claim to our business entrepreneur. So in that case, our business person, our insured, has to separately mention some insured for stock, some insured for cash, and some insured for goods held in trust. These are the underwriting consideration for burglary policy. Next, details of safe, that is weight, size, make, etc. If proposal for cash in safe. Proposal, if there is a proposal for cash in safe, then we have to know the size, the weight, and the make of the safe to ascertain whether we can allow the cash in safe policy or cash in safe in this burglary policy, or we should discard the same. So according to the details, we have to ascertain whether we are going to give them the policy or we can refuse the same. Today's market, when we are asserting, there are very good the safe makers like the Godrej or some other safe makers, wherein those safe will be considered as a good safe, wherein their weight size are very well maintained, and we can issue the policies if the weight and size is in good capacity. If the weight is very high weight, a person, 2 or 3 person cannot lift the total, the safe. Or if the makers are a very good company, then definitely to have the cash from the business premises, definitely it will be a very cumbersome process for those thieves, those burglar person, and the catch hold of the person is very well be done by our insured. So this cash in safe is to be given for a good safe where the weight and size matters. Separate fire insurance policy of the property, it is a must. To beginning at the beginning of our burglary session, I have already told that fire insurance of that property is must. And if you have issued a fire insurance policy, then as a best underwriter, you can issue a burglary policy. This is a prudent underwriting wherein you have to have a fire policy for the property. Next is cover restricted to cash oblique money in safe and not in steel almari or cash box. You are all, you must be aware that the business owner, our insurers may have the almira or the cash box, a small petty cash box in their business premises. But whenever we are issuing money in safe under this policy, then in that case, the money is to be kept in the safe only. It should be kept in the safe only, and by mere keeping it in any almirah, or the cash box, a small petty cash box is there, the our purpose is defeated, and hence we can restrict the coverages by saying that money should be kept in the safe and not in the steel almirah or the cash box. So this is underwriting consideration in the burglary policy. Next is all endorsement warranties to be attached. I have already explained to you the warranties. The certain warranties are to be imposed, certain endorsements are to be considered. The conditions are to be attached with the policies. The warranties are to be attached with the policies. These are the underwriting considerations in burglary policy. Now we will come to the types of policies. What are the types of policies? There are first full value policies. What is the meaning of full value policy? Insurance must be effected for the full value of the property to be insured. In simple way, to understand this, whatever is the property, whatever is the stock which the insured wants to cover under burglary policy, the full value of the stock is to be taken for the insurance purpose. That means suppose our insured is having textile goods of say 1 crore at any one location which he wants to insure for burglary policy. Already he has insurance for the fire policy of those textile goods. Then he has to insure total 1 crore as a value of the property to be insured. So total 1 crore is called as a sum insured. So this full value of policy is the sum insured, and total value is to be taken as a full value. In full value policy, there are two policies. First, non-declaration policy. Second, declaration policy. What is non-declaration policy? Once our insured submits us that the stock of the textile goods is 1 crore. That means we know that any point of time in 365 days, the highest value of stock in the premises will not exceed 1 crore. See, try to understand this. This is identical to the fire policy, wherein when the sum insured is declared or the sum insured is given in a proposal form, wherein it is stated that 1 crore will be the sum insured and we have to issue non-declaration policy. So in that case, the full value of policy 1 crore is insured, and this 1 crore sum insured is the value of the property at any one time, the highest value of the property at any one time within 365 days. So this is to be arrived to know the under insurance, the average clause. So the value is very important. The sum insured is very important, like fire policy. The sum insured is very important to know the under insurance or to apply the average clause. So first is non-declaration policy. Generally, we do not we do not issue the policy stating that the burglary policy non-declaration. Simple burglary policy without any nomenclature means it is a non-declaration policy. But when we say burglary policy, and in the bracket when we say declaration policy or burglary declaration policy, the nomenclature itself says that this policy is a declaration policy. The sum insureds are to be declared at a regular interval. We'll come to the next slide wherein the declaration policy in detail is described. Next is policy contains usual average clause. So the average clause, that is the under insurance principle, is also applied in all these types of policies. So this average clause or the under insurance clause is applied in burglary policy also. Then in the next types of policies, the first loss policy. What is first loss policy? The policies may be issued for an amount less than the total value of the property, with the stipulation that the company will pay the whole amount of loss up to the limit of sum insured. To simply understand what is first loss policy, suppose the insured is having engineering workshop wherein the heavy metals are kept. The manufacturing of heavy metals are the manufacturing process of your insured. So in that case, the mere theft or the burglary of that heavy material at that is all the heavy material at any one point of time is impossible. So your insured will ask you that, see, my sum insured is 1 crore. But at any point of time, if there is any burglary, if at all any burglary happens to my premises, my stock maximum how much it will be burgled? See, it may be say 25%. He may say it is hardly 50%. So in that case, he will ask you that I don't want the full sum insured, full value of the property to be insured as sum insured, but I want some part, that is the sum percentage, 25%, to be insured, and I will pay the premium on that part only. I will not pay the premium on the whole of the 1 crore sum insured. Then in that case, you have to charge the premium accordingly. What are those premium and how much you have to charge? We will understand when we see the next slide. First loss policy. The first loss policy acceptance should be considered in case of large warehouse and stores where value of stock is very considerable and of substantial and bulky nature, normally not less than rupees 10 lakh, rendering total loss a remote possibility. Example, bulk goods, machinery, etc. So as I said to you, what is first loss policy? There is a remote possibility of total loss. The total loss will not happen at all. That is what is the thinking of your insured. So he may ask you to issue a first loss policy. So you can issue a first loss policy. Here it is written that normally not less than rupees 10 lakh. This is a general underwriting consideration where the sum insured or the value of the stock to be insured should not be less than rupees 10 lakhs. This is to avoid the small proposals wherein very large number of clients may come to you and ask for this first loss policy. So to avoid that, this minimum sum insured, this is not actual minimum sum insured, but you can say that your sum insured should be at least 10 lakhs. So this first loss policy is to be accepted. This is to be considered in case of large warehouse and stores where value of stock is very considerable, very sizable, very substantial, and those are bulky in nature, where the total loss is a remote possibility. Then only you can issue the first loss policy. For your knowledge, I have come across one of claim in my divisional office wherein the LPG gas cylinders. I was considering these LPG gas cylinders is a very good risk wherein the burglary of this LPG gas cylinder is that much not possible. But still, I have come across a claim wherein more than 50, more than 51 gas cylinders are being stolen. So you never know whether these type of claims also come. So first loss policy, though I have issued a total policy, a burglary policy, when we are issuing a first loss policy, we should ought to know that the stock which is considered for this first loss policy, definitely there has to be a remote possibility of total loss. This is very important. Next is damage to the premises must be excluded in such policies. This is simple. In burglary policy, damage to the premises, these are must to be excluded in these first loss policies. This is very important, and for your point of view in the examination of 13.2, this first loss policy, its percentage of full value cover and the percentage charging of the premium you should know. What are these percentage? If you select percentage of full value cover as 25%, you have to charge 50% of the premium. Now to understand this, I will give you a simple example wherein the full value, that is the stock, is of 1 crore. Stock is of 1 crore. You are issuing a first loss policy wherein the insured has selected percentage of 25%. That means from this 1 crore, our liability will be restricted to 25 lakhs. Okay. Our liability is restricted to 25 lakhs. Then how much premium to be charged? Suppose for 1 crore, your total premium is 1 lakh of rupees. Your total premium is 1 lakh of rupees, which is as per the rating given by you. Then if the insured has opted 25% selection of the full value cover, that means our liability is restricted to 25 lakhs, then the premium amount to be charged is 50% of what is 1 lakh rupees you have charged. So the premium will be 50,000. In this case, once again I repeat, if the full value of the property is 1 crore and the premium charged as per the rating of burglary policy is 1 lakh of rupees. That means if he would have taken a burglary policy, in total, he has to pay 1 lakh of rupees. But suppose if he opts for a first loss policy, this is applicable for stock, and this first loss policy percentage selected by the insured is 25%. That means insurance company's liability is 25 lakhs because the total value, the full value is 1 crore. So in that case, at any point of time, the insurance company's liability will be 25 lakhs. Then you have to charge 50% of the premium. Since your premium for whole of the sum insured of rupees 1 crore is 1 lakh, if you opt or if you give 25% coverage under first loss policy, you have to charge 50% of the premium. It is not on pro rata basis. Please try to understand. It is not on pro rata basis wherein 25% of the coverage is given to the customer. Then we have to charge 25% of the premium. No, we have to charge 50% of the premium. That means whenever you are giving them a coverage of 25%, then our premium will be 50% of the premium which you have charged as a 100%. The example which I have given you, wherein I again repeat, 1 crore total sum insured. Insured has opted 25% sum insured, that is 25 lakhs. Our premium for total 1 crore value is 1 lakh. You have to charge premium of 50,000 and not 25,000. Got it? So accordingly, the percentage value of full cover selected by the insured is given on the left hand column, and on the right hand column, the selected charging of premium, the percentage is given, and accordingly you have to charge premium. So suppose your insured has asked for 75% selection of the full value cover of the same example. Naturally, the insurance company's liability will be 75 lakhs, whereas the premium to be charged is 90,000, because the whole premium, the whole full value premium will be 1 lakh, but since the sum insured opted by the insured under first loss policy is 75%, that is 75 lakhs, we have to charge 90% premium, that is 90,000 rupees. So this is the first loss policy and their percentage is given. Please try to understand the percentage which is given as a selected percentage by the insured or the customer. Our premium chargeable will be according to the percentage specified. and not as per pro rata basis. So according to this percentage, you have to charge the premium. But at any point of time, what will be our liability? Our liability will be 25%, 50%, 65%, or 75%. So as per the selection done by the insured, our liability will be restricted to the percentage. So for 1 crore of the total sum insured, that is full value, our liability will be restricted to 25 lakhs for 25%, 50 lakhs for 50%, 65 lakhs for 65%, and 75%. So this goes on. This is, in short, the first loss policy, and this is applicable for stocks only. Now next, the declaration policies. As I told you previously, earlier, that the declaration policies, we need to understand what are these declaration policies. The declaration policies, these policies may be considered where large stocks which fluctuate considerably during the year are involved along the same lines as fire declaration policies. In this pandemic situation, you must have come across with many of the declaration policies proposals, because the stocks were fluctuating like anything. Before pandemic, the business owner or the business persons might have thought that there will not be any fluctuation in the stock. But in this scenario, he is considering the stocks, it may fluctuate according to their business. These stocks may fluctuate considerably, and he don't want to have the burglary insurance for full value. He wants to have a declaration policy. Then what is this declaration policy and how it applies, we will come to know. So first, these policies may be considered where large stocks which fluctuate considerably during the year are involved along the same lines as fire declaration policy. These are with the same lines as per the fire declaration policy. The probable highest sum insured at any one time during the period is taken as the sum insured of the policy, and 100% premium on the same is to be collected as deposit at full value rate. The example previously which I have given in the first loss policy, wherein I have stated that the full value is 1 crore, and in that 1 crore, the premium chargeable is 1 lakh annually. So here, if you are issuing a declaration policies, there are certain criteria under declaration policies regarding the minimum sum insured, and accordingly you can give the declaration policy. So the highest sum insured at any one time during the period is taken as the sum insured. As I said earlier, what is the value, what is the sum insured, and how you can ascertain the sum insured? That is the value of stock at any one time. The highest value of stock at any one time during the 365 days is considered as the sum insured. Then this sum insured, accordingly you have to charge 100% premium. For 1 crore sum insured, you have to charge 1 lakh as a full premium. Then what is difference in normal burglary policy and this declaration policy? The declaration policy states that you have to declare the values of the preceding month on the first day of the next month. So these values may fluctuate. How it will fluctuate? Suppose 1 crore sum insured is taken in the month of January, we have issued the policy. On the 1st of February, the client has declared that the value, the highest value or the average value is say 95 lakhs. That is not exactly 1 crore. In February, he may say that, or he may declare that the value in the month of February was 85 lakhs. Though he has taken insurance for 1 crore, the fluctuation may arise in the month of March, wherein in the month of March, the value of stock declared is say 1.05, 1 crore 5 lakhs. And accordingly, the every month declaration is to be considered. So here you cannot charge the premium if here the value is exceeding 1 crore at any particular month, but these policies are adjustable at the end of the year. So at the end of the year, you are taking the average of these 12 months sum insured, and after taking the average, if the sum insured what you are getting is more than say 1 crore, if the sum insured is more than 1 crore, you have to charge premium accordingly. And if the sum insured is less than 1 crore, you have to refund the premium. Have you understood this? These declaration policies are for the stocks which fluctuate considerably during the year, and you can pay or you can refund the premium, or you can get the premium at the end of the year when you are having the sum insured, the average sum insured after the end of the 12 months. So these are the declaration policies. Suppose if there is a case wherein after the month of March, he has declared 95 lakhs in the month of January, 85 lakhs in the month of February, 1 crore 5 lakhs in the month of March, and in the month of April, the insured has not declared any sum insured. Suppose he has not declared, there is a condition that the insured has to declare the sum insured of the preceding month on the first day of the succeeding month, the next month. But he fails to declare. Then in that case, to come at the average sum insured, what insurance company is deciding, that the value of the stock is considered as the sum insured. That means in the month of April, he has not declared anything. Then the insurance company is taking the value as 1 crore. Why the insurance company is taking the value as 1 crore? Because he has taken the value as 1 crore. So accordingly, this is charged. Usually 50% of the provisional policy premium is at least to be retained. So when I say that there is refund. So this refund is how much refund you can pay. The refund will not exceed more than the 50%. See, you have given a policy, this declaration policy, for sum insured of 1 crore. If due to certain reason, his stocks from January to December varies in the category of say 35 lakhs, 45 lakhs, 40 lakhs, 25 lakhs, and if the average stock after the end of 12 months comes to say 45 lakhs, then the premium which you have to refund to the customer is 50, the premium on rupees 55 lakh. So if you consider the percentage, it will be somewhere in the premium consideration of 55%. But as per the condition of the policy, minimum 50% of the provisional policy premium is to be retained. So this premium is retained with the insurance company, and if it is exceeding the 50% value, you have to make the refund. Suppose the refund, if it comes to say 55%, then you cannot pay 55% refund. You have to keep 50% with the company, and balance you can refund. So you are not supposed to pay the whole of the refund, the 55% refund, but you have to keep the 50% provisional policy premium which is to be retained. So in our example, when you have issued a policy wherein the premium is 1 lakh of rupees, you have to retain 50,000 minimum premium. You have to retain 50,000 as minimum premium, and whatever is the balance, that may be refunded to the insured, to the customer. So these are the declaration policies. Now the floating policies. Now the floating policies, these are the policies wherein we should cover the goods in more than one location under one sum insured. There is a question in the chat box that is there any difference of time in fire and miscellaneous for submitting the declaration? Yes, the declaration are to be submitted in the first day, on the first day or the first week of the succeeding month. That is, if the declaration of the January month has to be declared on the 1st of February or in the first week of February, there has to be certain, these are the restrictions or these are imposed while issuing the policies. So this is this is related to our declaration policies. Now we will come to the point of floating policies. Generally, floating policies are not issued in burglary. Generally, these policies are not issued. But if we have to issue a floating policy, then what are the underwriting consideration and what is that we can cover? We can cover the goods in more than one location under one sum insured. So this is a nomenclature of floating. You must be aware of floating policies in fire. Then here the sum insured is one sum insured is given by our insured, by the customer, and the goods are stored in more than one location. Say for example, our insured has 5 different locations and the total sum insured is 1 crore, wherein the insured cannot ascertain that the stock in Mumbai, the stock in Delhi, the stock in Ahmedabad, the total stock is 1 crore, but he cannot ascertain that any one point of time what will be the stock in Mumbai, what will be the stock in Ahmedabad, what will be the stock in Delhi. So in these cases, he may ask you to issue a single policy, for rupees 1 crore, because he is aware that in all the location which he is describing, he is giving the location details, and in all those locations the total of the sum insured will not exceed 1 crore. But at any point of time in any one location, he cannot ascertain what will be the value. Then in that case, these floating policies are issued. This is identical to our fire floater policies. So here, first point, these floating policies are covering the goods in more than one location under one sum insured. So the sum insured is single sum insured. Secondly, the subject matter of insurance has to be identical in all locations. What this means? If the insured is in the business of textile, the garments, then the stocks which are stored at Mumbai location, Ahmedabad location, Delhi location has to be of garments only. He cannot say that in my Mumbai location, the stock stored is of garment. In Ahmedabad location, the stock stored is of food grains, and in Delhi location, the stock stored is of machinery. No, the our insured has to insure his property or the stock which is of identical in nature. So the subject matter of insurance has to be the garments only. If he wants to have the machineries to be insured, if he wants to have the food grains to be insured, the subject matter should be identical in all the locations. Then only we can issue the floating policy. The policies, the next one, the third one, the policy is issued when separate sum insured is not available. As I told you in the first instance itself, that one single sum insured is given by the insured. So no separate sum insured is available. So separate sum insured is not available. The next one is they are issued only to well-known clients. As I told you earlier, floating policies in burglary are remotely used. we are issuing minimal of these floating policy because these are issued to well-known clients, our valued clients, which are on our books from years, wherein their moral hazard and the claim ratio is a very good incurred claim ratio. Then only we can issue the floating policy. Then comes the valued policies. What are the valued policies? Valued policies are those wherein valued policies, or you may say agreed value policy. You must have come across this term, agreed value policy. What is this agreed value? This is agreed between the insured and the insurer. The insurance company and the insured, they have agreed the value of the stock, or they have agreed at certain consideration of the value, and accordingly the valued policies are issued. These are the contracts where the sum insured is deemed to be actual value of property insured. So the sum insured is the actual value of property. There is no appreciation, there is no depreciation. Once you have issued these valued policies, the actual value of the property is considered as a full value. So these valued policies are issued to whom or to which stock? Those are the paintings, the pictures, the curious, antiques. For these, we can issue the valued policy. Again, for such type of valued policy, a very strict underwriting consideration, a very strict underwriting decisions are to be considered, and then only issue such type of policy. Generally, these type of policy under operating offices, they are not allowed to issue these policies, but these are the authority of the regional office or the head office. So accordingly, the valued policies may be issued, but these are called as agreed value. And when once you have agreed for certain paintings, when you have agreed for certain pictures, then in case of the burglary of these paintings or the pictures, you have to give the full value of claim to the customer. So these are very strict underwriting consideration valued policies, and we have to be very careful while issuing these type of policies. Even the next slide which I am going to show you, that is of the policies which are inventory, and which are the policies with inventory and valuation clause. Again, these type of policies are not generally issued. And what is this inventory and valuation clause? I will go one by one. A burglary policy, it is a contract of indemnity, and insured requires to produce invoices and other evidence of cost to establish his claim. See, you must know and you must be aware that the policies of burglary, when you are issuing to the customer, the onus of proof, that is the establishment of the facts by supplying the proper evidence of the cause, is on the insured. Insured has to submit the invoices, insured has to submit the bills, insured has to submit the evidence of the cost of the property insured to establish his claim. So it may happen that these invoices or the other evidence may not be there with the insured. So in that case, this inventory and valuation clause will come in picture. How this will come in picture? Next point is, this saves the insured from this cumbersome procedure. What is the cumbersome procedure? To produce the invoices and other evidence of cost. But if you have to save the insured from this cumbersome procedure, inventory and valuation clause is to be given. Again, this point is to be noted that this is a very underwriting consideration to ascertain, and it is to be given to the valued clients only, not for general clients, not for the stray clients wherein they are taking a policy and next year they might not take the policy. So for those, you don't have to issue the policy with this clause. The third one, what this inventory and valuation clause provides. This clause provides inventory and valuation of the contents by a professional valuer. So to ascertain the value of the property, To ascertain the value of the content, a professional valuer is engaged. He will submit the insurance company the valuation of the contents by jotting down or giving one by one the name of the property, its value. Second, the name of the property, its value. And accordingly, the value can be ascertained. The inventory is given and accordingly the valuation is given by the professional valuer. So definitely when professional valuer is giving the value and insurance company, when it accepts those value, it will come as a agreed value policy. It is a type of agreed value policy only. So these are the next one, the last one. The value said by a valuer is accepted as the value of property. So this is the value given by the professional valuer and it is accepted as a property, and hence the production of the invoices or the other evidence of cost is then not to be considered, and the insured is saving his time to submit those cumbersome procedure of establishing the evidence by submitting the invoices. Then risks to be avoided. Which are the risks to be avoided? Risks situated in the interior. Interior means the remote places. These are to be avoided. The jewelers, as I said earlier, a separate jewelers block or separate jewelry package policy is to be given to the jewelers, and you do not issue the burglary policy. The dealers in precious stones, curious, antiques, as I said, the valued policies will come in picture, and generally these risks are to be avoided. Watchmakers and dealers, yes, watchmakers and dealers, we have to avoid these type of risks. Why? Because these are the high value material and in a small quantity. That is the single watch, the these fossil watch or these watch, a single watch may cost 10,000, 20,000, 50,000, and the easy access of burglary will be there, and we may come across very large claim for these watchmakers and their dealers. Gold and silversmiths, that is goldsmith, silversmith, we are not issuing or we are avoiding the risk. The furious, the money lenders and pawnbrokers, the athletic clubs, sports pavilions, stamp dealers, tailoring establishment, launderers. So there are, this list is not exhaustive but indicative. This is the indicative list because there are n number of risks which you have to ascertain while issuing the burglary policy. So these are some of the risks which we have to avoid and do not issue burglary policies to these entrepreneurs. Next is documents required for claim procedure. What are the documents required? These are generally, as you know, a burglary, that means theft or steal or stolen of the material. Then the police reports are must. The police reports are must. So after the duly completed form, which is duly signed and stamped by the customer, the insured, the copy of first information report, that is the police FIR, is mandatory. The police FIR is very essential document in burglary policy. Unless and until you have this police first information report, that is FIR, you cannot process the claim, because the police authorities are the authority who can ascertain or who can say that there is a burglary or there is dacoity or there is robbery. Then we are appointing the surveyor or the investigation, and their survey report or the investigation report is part of the claim document. Then the copy of final investigation report issued by the police authority oblique magisterial order. What is the difference between the reports, final investigation report issued by the police authority and the magistrate's order? The final investigation report issued by the police authority saying that suppose there is a burglary in insured premises, business premises, and he has lodged a police FIR. The first information report is given by the police authority saying that yes, there is burglary and they are investigating in the case. Suppose the insured says that my 20 lakhs of the material is stolen. Then the police authorities, they investigate the matter and come to the conclusion that yes, in the final investigation report, they say that the 18 lakhs of material is stolen. They are ascertaining and investigating and coming to a conclusion of say 18 lakhs material is stolen. The said final investigation report is put to the authority of the judicial, the magistrate, and the judicial or the magistrate, they give the order wherein the final investigation report is that the report is correct. It is done by the police authority, and then they give the order that this stock which is stolen is of 18 lakhs, and after the magistrate give the order, this is the required document for giving any claim. So we have to know what is first information report. This is the information given by the our customer, by our insured to the police, wherein police does the panchanama. In general term, we call it as a panchanama, and the police are giving all the details about the incident. After that, they investigate the matter and then come to conclusion about the burglary. After the conclusion, it is submitted to the judicial authority, and the judicial authority gives the order. So these are certain claim documents which are to be submitted by the insured. The last and very important point we should ought to know is the letter of undertaking oblique subrogation form, which is to be obtained from the insured. What is this letter of undertaking or subrogation form? You all know the principles of insurance: utmost good faith, the indemnity, insurable interest, and in those principles, one of the principle is subrogation. What is this subrogation principle? This principle is a principle for right of recovery for the insurance companies. What this subrogation principle says, that once the order is issued or the final investigation report of the police says that 18 lakhs of material is stolen, and insurance company has paid rupees 18 lakhs to the insured, and suppose after 6 months the police with their efforts has obtained, or they caught that thief or those thieves or those robbed person, and they took them to the custody wherein some of the material is being retrieved by the police authority. Say for example 5 lakhs. 5 lakhs of the material is considered or it is obtained by the police authority, and those 5 lakhs are part of this claim which insurance company has already given to the insured. The insured has already got rupees 18 lakhs for which he is indemnified. But after say 6 months, the police authority with their efforts has grabbed those persons and could retain or could retrieve 5 lakhs of stock. Now that stock is the property of the insurance company. Suppose if that 5 lakhs of rupees stock is again given to the customer, then the principle of indemnity is defeated. They are going to have the profit because they have already given or they have already been paid rupees 18 lakhs, what is their claim amount. So these 5 lakhs is the right of recovery of the insurance company, and this right of recovery under the subrogation form is to be obtained from the insured at the time of settlement of the claim. This right of recovery of the insurance company is to be obtained from the insured by way of subrogation form or by way of letter of undertaking. So these are the documents which are required in the claim procedure of burglary policy. There are certain other policies of burglary, like burglary private dwellings insurance policy. I need not have to go in much detail of this because you must be knowing the private dwellings policy for burglary. Then pair and set clause. The pair and set clause is very important point to know, because what is this pair and set clause? Suppose in a jewelry, you must be coming across many of the jewelry items wherein there is a set of a necklace and earrings, a necklace and two earrings of identical shape, design, everything, which is a set of the jewelry. Suppose in those two earrings, one earring is stolen. The insured may say that though only one part or only one earring is stolen in that pair, he thinks that this set or this pair is of no use. So he will claim for both the earrings. But our underwriting consideration and claim procedure will not allow to give both the pairs amount. We will restrict ourselves to a single earring which is stolen, and the value of only one earring is given to the value or the claim of only one earring is given to the insured. So pair and set clause, wherein the insured may say there the emotional bindings of the insured in that set, the jewelry set, may occur, but as far as insurance company is concerned, we are not giving a claim wherein we say that okay, the pair is there and only one earring is stolen, but still we will pay for both the earrings because your pair is not matching. No, we will not give such type of liberty, and we will pay for only one single earring in that pair, and the claim will be settled. Accordingly, the set. Now this is a pair, and what is set? The two earrings and the necklace is a set. So he may say that due to this one earring stolen, my whole set is disturbed. You have to pay me the claim for the set. Then again we should say that no, we are not paying the entire pair amount or the entire set amount, but we will restrict ourselves to a single earrings which is stolen. This is called as pair and set clause. This comes under burglary policy. Then third one is all risks insurance policy. This is a part of the burglary. You may say that these all risks generally are issued to the jewelers or the jewelries or the valuable, the household persons or the house owners. They are taking these type of policies. The valuable things like watches, the valuable things like the jewelries will come under this category. The high valued cameras, these are coming under all risk insurance policy. Then the baggage. This is again a baggage. You may say that the accompanied baggage. Baggage in general terms is called as accompanied baggage and not the cargo. Not the cargo which is to be transported from one place to another, but it is the accompanied baggage along with the insured. When he is traveling, he is having a fear of burglary of this baggage or the stealing of this baggage in traveling. So it has to be the accompanied baggage. So these are some of the other policies of burglary. So this is in nutshell the burglary policy and the things which you should know. There are certain nomenclature which you should know. What are the certain types of policies, like the first loss policy, the declaration policy, the valued policy, or the floating policy. These are the part of burglary policy. So this is a burglary policy. Yesterday, we come across certain terms like the burglary, dacoity, robbery, theft, and their sections. Their sections under Indian Penal Code. So, exam point of view, you should know what is section 445. You should know what is section 378. So, these are the sections of the Indian Penal Code, and accordingly, you should ought to know what these means, a burglary or robbery or the dacoity. So that was all for burglary policy. And we'll start with money insurance. We will start with money insurance. As you all are aware that there is always a threat, there is always a fear for the business person that their money, whatever they are earning by way of their business, may lost or may be stolen in transit. So our this subject or this topic of money insurance deals with the money. So this money insurance can be termed also as cash in transit insurance. So the second nomenclature for the money insurance is cash in transit. A very popular name for money insurance is cash in transit insurance. What this money insurance or cash in transit insurance says, or what it covers. This covers loss in transit of money or the cash by the insured or his employees. Second, loss by robbery, theft, hold-up whilst in insured premises or strong room. Third, cash, bank draft, currency note, postal order, postage stamps, that is postage stamps, those are covered. And the last one, the wages, unpaid salaries, these are covered against burglary, provided it is retained in the strong room. So when we come across these 4 points in money insurance, what we are covering, first, we are covering the loss of money in transit, whether that money is carried by the insured, that is the owner, or his employees. So if there is any loss in transit, that is covered under money insurance. Second, loss by robbery, theft, hold-up, while it is insured, it is there in the insured premises or the strong room. So there are two things involved in money insurance. First, the cash in transit, and second part, the cash which is kept at the business premises. So the cash doesn't mean the currency notes only. The cash means what? The cash, that is currency notes, the bank drafts, the postal orders, the postage stamps, all these, and insured has to declare that how much will be those currency notes, how much will be the value of the bank draft, or how much will be the value of the postal order. He has to declare. Generally, the insured, they are interested to have the cash to be insured. That is, the currency is to be insured. Then the last one, the wages and unpaid salaries. There are certain days wherein the salary is to be disbursed. So these wages or the salaries are withdrawn from the banks and it is kept in the custody of the insured in the insured premises. But those monies or that cash is kept in the safe or in the strong room. So this is the money or the currency which is kept in the insured premises. So there are two things. We should know, as I have shown you in this slide. Section 1, money in transit. Section 2, money in safe. What is money in transit? The money in transit is the cash in transit between the insured premises and the bank, or between the insured premises and the specified place or specified location. So in our proposal form, the insured has to submit us the where is the location of the insured premises and where is the location of the bank, and according to the radius of kilometer. See, this is very important underwriting consideration in money in transit, that is cash in transit, that the insurance company will have to know how much distance is covered and in how much distance this money is carried. Suppose the distance is very less. Say, for example, the bank premises and the insured premises, the specified premises of the bank is in the vicinity of 1 kilometer. Then this is to be considered as a safe risk. But if the bank premises where the money is to be carried is, say, 20 kilometers away from the insured premises, then this is to be considered as a bad risk. So whenever the radius of kilometer expands, when there is more number of kilometers, then our risk is more. insurance companies risk is more and we are charging high premium. But if the vicinity of the bank premises or the specified location is within a vicinity of say 1 kilometer, 500 meters or within 2 kilometers, we will give a discount in the rating pattern and we will take a lesser premium. So accordingly, money in transit, there are certain things you should ought to know. The first thing, the insured premises and the specified location distance. Second one, how the money is carried. How the money is carried. That means if the money is carried in a bag or it is carried in a thaili or if it is carried in a plastic or in a carry bag. So according to the degree of hazard is there. So first, how much distance. Second, how the money is carried. Third, who is accompanied with that person. Suppose for example, the cashier himself is going to the bank to withdraw the salaries. Along with the cashier, if any armed person is there of the insured, then this is considered as a very good risk because the threat of money to be stolen is very minimal because the armed person is accompanying the our insured employee. So the risk is very less. The distance, the money, how it is carried, then accompanied person along with the person who is carrying the money. And the next important point we should know about the money is that how it is going. We know the distance, we know the bag or the baggage, how it is carried. We know that the armed person is there or not. Singly only insured is going or singly any employee is going. But how he is going to the bank or how he is traveling the distance. Suppose he is taking any public transport, say a public bus, a road transport bus or auto rickshaw or taxi, then the chances are much more. The chances of theft or burglary of this money is more in public transport. But suppose if the insured goes with the with his own car, with the insured car or company's car, or the employee of the company goes with the company's car, then the risk is minimized. It is not that the risk is totally vanished, but the risk is minimized as compared to the public transport. So these are certain underwriting consideration accordingly you can charge the premium. So second section, first section we saw about the money in transit. Second section is money in safe, the cash which is kept in safe in the business premises. This is a cash or the money which is saved in the locked safe, and generally it is kept for 48 hours or 72 hours. This is our clause in money insurance to keep the money in locked safe for not more than 48 hours or not more than 72 hours. This is a condition for the money to be kept in safe. So these are the two sections under money insurance. Now we'll come across the two amounts which are to be specified by the insured in the cash in transit policy. What are those two amounts? First one, limit of insurer's liability for any one loss and estimate amount in transit during the year. The insured, when he is saying that my total amount of money in transit during the year is say 5 crore. That means he is giving you the estimated of turnover. What is his turnover of cash? 5 crore. So he is stating that the estimated amount of transit during the year is 5 crore. Then what will be the liability of the insurance company? Whether it is 5 crore? No. Our liability, the insurance company's liability for any one loss is to be given by the insured. What is this amount? This amount is the amount which is carried in transit from the insured premises to the specified location, and this amount is the insurer's liability. say for example, when your insured is giving the estimated amount in 1 year as 5 crore, the whole of 5 crore is not going to be burgled or theft, or the theft of whole 5 crore will not happen at any one instance. At any one instance, the maximum amount which is stolen will be a certain specified amount. What will be the amount? That will be specified by the insured. And insured may say that my highest amount at any one carrying point or any one carrying limit is say 10 lakhs. Then the insurer's liability will be 10 lakh for any one loss. So our liability will be 10 lakh for any one loss. Then what amount of premium or the rate of premium is to be charged on what? That a question may creep up in your mind, whether it is the rate is to be applied on the specified amount in transit or the estimated total amount of transit during the year. To know the rating pattern, the rating is to be applied on the whole value, the estimated amount in transit during the year. In our case, when we say that the estimated amount in a year is 5 crore and the highest value of cash which is carried at any one point or any one time is 10 lakhs, then we have to charge the premium on 5 crore and not on 10 lakhs. We have to charge premium on 5 crores. Suppose it may happen that during the transit, the that is the within the transit, the 10 lakhs money is stolen. And in the next month, again say 8 lakhs of rupees is stolen. Both these incidents are covered since insured has taken the value of sum insured on estimated amount of 5 crore. So this is very important, and the two amounts which are specified by the insured we should know, and we should charge the premium accordingly. But try to understand that what will be the insurer's liability. Insurer's liability will be the amount of loss which is there in transit. In our case, when we say that the amount specified in one single transit is 10 lakhs, our liability at any one loss will be restricted to 10 lakhs and not rupees 5 crore. Okay. The next point is declaration policy can be issued and premium adjusted on renewal. According to the burglary declaration policy, we can issue the declaration policy for this cash in transit, wherein the business entrepreneur or our insured may not, or he may have the fluctuation in the money also. So in that case, you can issue the declaration policy. Insured will have to keep records of all the money transactions that are carried on involving various transit. See, all these policies which we are discussing, like the money or the burglary or the burglary various types of policies, these are issued to your good customers. Good customers means who are having a good moral hazard. Then only you can issue these policies. There are certain exclusions under this money in transit, cash in transit policy. These are shortage due to error or omission. If there are any shortage while taking the cash by the cashier or the employees, these shortage are not covered under the policy. Those are the excluded. Loss of money entrusted to any person other than the insured or his authorized employees. See, when insured person is stating that the money is carried by myself or my employees, the authorized employees, and if that money is given by the insured person to some other person other than his authorized employees, and if there is any loss to this money, those will be excluded. This is a very important thing. The third one, losses due to fraud, dishonesty of the employee of the insured. these losses which are there, which because of the dishonesty of the employee or because of the fraud, if there is any loss to the money, those are excluded. But if those are discovered within 48 hours, that is within 2 days, those will be covered. Those may be covered. The next one is loss occurring on the premises after business hours unless money is in locked safe or strong room. You know, when you are coming, you must have come across with the proposal form wherein the money, there are three sections or there are 3 points which we are asking to the insured about: the money kept in safe, money kept at counter, and money which is kept in the premises. So money which is kept in safe, money in transit, and money kept at till or counter. So what is the meaning of these things? Money kept in safe, money kept at counter. Whenever the business premises are running, see, for example, the business starts at 10 o'clock in the morning and it is shut at 8 o'clock in the evening. So within these 10 to 8, the money is kept at the counter. So if there is any robbery or theft which is occurred to this money when it is kept at the counter during the business premises, you can cover it by paying the additional premium. But after the business hours, please note, but after the business hours, if the money is still kept in that counter or in that drawer or in that till, and if there is any loss to this money, our policy excludes these types of losses. Because what our condition says, that after business hour, that is after 8 o'clock in the evening, it is the duty of the insured to keep this money in the safe or strong room. Then only that money can be covered. The next one is loss by riot, oblique strike, and terrorist activity. This is again not covered, but you can cover by asking the insured to pay the extra premium. So riot and strike, in general term, we call it as SRCC, riot, strike, civil commotion, and terrorist activity. These are excluded under money policy, but we can insure or we can give this coverage as add-on cover by charging extra premium. Theft of money from unattended vehicles. What this means, the money which is carried by the insured or the employees with, say, by he is going to the bank premises, the insured is going to the bank premises having 10 lakhs of cash and he is going to deposit, or if he is withdrawing the money from the bank and coming to the insured premises. While coming from the bank to the insured premises, in traveling or in journey, suppose if he is taking any refreshment at any one of the hotels and he has kept the bag of rupees 10 lakhs in that vehicle, where he is traveling, and he goes to the hotel to have the food and tea. The vehicle is termed as unattended vehicle because though it is locked, though the vehicle is locked by the insured, it is termed as unattended vehicle because there is no attendant to look after the money which is kept in the vehicle. And if any theft occurred of that money from these type of vehicles which are unattended, those are excluded under this money policy. These are the exclusions: theft of money from unattended vehicles, loss from safe by use of its key unless the key is obtained by use of threat or violence. This is again a key clause. We come across this key clause in burglary policy wherein the person who are stealing these or taking this money from the insured with the force and obtains the key from the insured or their employees, then in that case, this loss of the money is also covered. But this loss of money is covered if it is under the threat and the key is obtained, then only this can be covered. Otherwise, the loss from the safe by use of its keys is not covered. Suppose the keys are taken, the keys are being available to the burglar person or the thief, and he can have the easily access for the money. Then in that case, we are unable to pay the claim. But yes, if the keys are obtained by threat, then we can pay the claim. There is one question here. If we take lift from any unknown person, it is covered to go to bank. In ideal situation, when any employee or the insured person is carrying the money, he should either use a public transport or his own vehicle. By having a lift with any of the person where you are not knowing the person, then definitely this claim will be going to be a difficult claim, because you have initiated yourself to a danger, you have exposed yourself in a danger, and your money is not in the safe risk. So this claim may be turned down. So either a public transport wherein a public servant, the public authority is there, or your own private vehicle is engaged, then only you can carry the money. There is one question also, in money insurance declaration should be mentioned on which day? Again, the same nomenclature of our declaration policy comes in picture. The money, when you are declaring, it is to be declared at what will be the highest value, and same way on the next month you have to declare what is the average money or the highest money at any one point of time. So this is according to our declaration policies only. The extensions under the policies. What are the extensions? Infidelity of employees, riot, strike, terrorism, disbursement risk, money in safe, money at business counter. All these things I have already discussed, but to sum up all these things, I would like to elaborate certain points. What are the infidelity of the employees? That those employees who are carrying the money, he himself ran away with the money. If the insured person has taken this extension of infidelity or dishonesty of the employees, we can cover under the claim. Right strike terrorism, I already narrated you, SRCC, right strike civil commotion, that can be given by taking the extra premium. Disbursement risk, yes, when the money is carried and it is there at the business premises. Say for example, on 30th of every month, there are the wages to be disbursed to all the employees. In that business premises, when suppose 10 lakhs of cash is to be disbursed to 30 of the employees, this is a disbursement risk. So while disbursing this money, if there is burglary, if there is theft of all those money or the cash, then we can cover, provided the insured has taken the extension of disbursement risk. Money in safe, I need not have to elaborate. Already I have given much ample of the time for this money in safe, and also on money at business counter. So these are the extensions under the policy. So that was all about money insurance. The next part is fidelity guarantee. This is again related to money. We are coming across the terms of burglary, the money insurance, and fidelity guarantees. These are in accordance with the policies. The fidelity guarantee is part of the money policy. Money is part of the burglary policy. So this is in chain with all these policies. What is fidelity guarantee? Fidelity guarantee is the guarantee. The fidelity guarantee is a guarantee given, or it is the policy which is taken by the insured against the infidelity of the employee. So what is fidelity? What is infidelity? Fidelity means faithfulness or loyalty. And what is infidelity? Unfaithfulness or cheating or disloyalty. So infidelity policy, we are covering. What we are covering? We are covering the infidelity of the employee. So this fidelity guarantee, this policy covers the employer towards direct financial loss from employees' dishonesty. There are three parties concerned. One is insurer, second is insured, and who is the third party? The person whose fidelity is being guaranteed upon. So this person is very important in fidelity guarantee. This person may be a cashier, this person may be the substaff, the peon, and his infidelity is covered under this fidelity guarantee. Fidelity guarantee covers direct pecuniary loss sustained due to fraud or dishonesty committed by the employee during the uninterrupted continuance of employment. See, please try to understand this point. The fidelity guarantee covers a pecuniary loss, not the consequential loss. What is pecuniary loss? A pinpoint loss, a loss which is to be established, which is to be ascertained. This direct pecuniary loss sustained due to fraud or dishonesty committed by the employee during the uninterrupted continuance of the employment. Suppose if the insured has removed or he has sacked that employee after say 2 months, and after next 2 months again he is being involved in the employment, and then the fidelity guarantee, he wants the fidelity guarantee for all this period. We are unable to issue such type of policies because we are issuing these type of policies to those employees who are in the uninterrupted continuity services of the employer. There only we can give this policy. The limit of compensation is the specified sum insured. What is specified sum insured? This is to be ascertained by the insured for each of the category of the employee. Suppose insured thinks or insured is having a fear that cashier may have the excess of 2 lakhs of rupees, 2 lakhs of the money, then he may say to the insurance company that yes, I want the fidelity guarantee cover for my cashier, and the specified sum insured is rupees 2 lakh. If the substaff or the peon who is carrying the money to the bank, he is carrying the money not more than 50,000, then the insured may say that for my employee, the substaff or the peon, my fidelity guarantee sum insured will be 50,000. So according to the position, you can issue the specified sum insured under one single policy. This is fidelity guarantee policy. Loss due to bad accountancy is not covered, as also omission is not covered. Bad accountancy and omission, if there is any omission by the insured, or if there is any omission or bad accounting procedure, this will not be covered. This will not be covered under fidelity guarantee. Act should be committed in the course of duties. This act, what is the act? What is the dishonesty? What fraud? Everything has to be committed in the course of duty. After the duty hours, if there is any fraud done by the insured employee, that is not covered, because it has to be done, or these acts should be committed in the course of the duty. That does not mean the duty hours, but during the course of duties, the act should be committed by the employee. The fidelity guarantee will come in picture if it is committed during the course of the duties. The direct pecuniary loss, as I said earlier, it is to be allowed if the uninterrupted continuance of employment. The second one, the limit of compensation is the specified sum insured. This is the same slide. What is the time limit for discovery of losses? There has certain time limits for discovery of losses. What is that time limit? The acts insured against should not be discovered later than 12 months after resignation, dismissal, retirement, or death of the employee, or not later than 12 months after the termination of the policy. What is this time limit for the discovery of losses? It is the 12 months period. What is this 12 months period? That this type of any fraud or the dishonesty should not be discovered after 12 months. So it has to be discovered within 12 months, then only our claim will trigger. If the dishonesty or the fraud is discovered, say after 1 year or after the termination of the policy, then we are not liable to pay the claim. So it is to be discovered within or before 12 months after resignation or dismissal, retirement, or death of the employee. That means, suppose if there is any fraud, if there is any dishonesty by the employee, then it is to be discovered within the 12 months after resignation, or suppose if the employee has given the resignation or the employee is retired and the insured come to know that the dishonesty or the fraud has been done by that employee and it is discovered after 12 months, then in that case our claim will not trigger, we will not pay the claim. And what is the second clause? It should not be later than 12 months or after the termination of the policy. If the policy is terminated and still the claim is not lodged, we are not liable to pay the claim. Application, there are certain things which are to be considered for underwriting guidelines. Application of precautions and control measures and supervision of the employee. This is a must from insured point of view, and in turn the insurer should know that these precautionary measures and control measures are being taken well care of by the insured. Advise insurers regarding change in nature of duty so that premium chargeable can be considered. Suppose if any person who is there in the normal employment and after certain time, say after 2 months, that employee is engaged as the cashier, then that insured has to inform the insurance company that this the specified person is now cashier and who is handling the cash. So accordingly, the premium is chargeable. Immediate notice of claim. Immediate notice of claim is very important, that within 24 hours, you have to intimate the loss whenever it is discovered immediately to the insurance company. Subsequent to the loss, the policy stands cancelled in respect of the defaulting employee. This is one of a key point, a valid point which you should know in this examination, that suppose the fidelity guarantee of one cashier, a position policy is issued for a cashier, and if the loss is occurred, if the dishonesty is taken place, then in respect of that defaulting employee, our policy stands cancelled. So this is a fidelity guarantee policy. Again, the subrogation, the right of recovery is there. The contribution, pay pro rata with any other policy, termination of policy, arbitration. These are common features under any policy. Yes, now according to the fidelity guarantees involved, there are certain policies which are to be issued. There are certain policies. First, individual and collective policy. The nomenclature itself shows individual means it is given to a particular individual. A collective policy, it is given to the number of employees under the business premises, or the insured has taken a collective policy. Floating policy, specified sum of guarantee is floated over the whole group. Again, here the sum insured is floated amongst the cashier, the substaff, the manager, or whoever persons who are specified by the insured, and only one single sum insured is given, or a specified sum of guarantee is given. So this is called as the floating policy. Position policy, position is guaranteed for a specified amount so that a change in the person holding the position does not affect the cover. Position policy, when it says, then the position is to be given, or it is to be described, say cashier, say substaff, say manager. These positions are to be submitted by the insured, and whoever the person on that position, it is to be established, or it is to be evidence, the evidence is to be given by the insured. So these position policies can be issued. What is blanket policy? It is, this covers entire staff without showing the name and position, but references must be made available to the insurer in the event of a claim. So in blanket policy, the blanket policy covers the entire staff, their name or the position. As in the individual policy, we ought to know the name, but in floating in the position policy, we ought to know their position. But in the blanket policy, we cover the entire staff without showing any name or position, but only the references are made available to the insurance companies. So thank you very much. This all was about the fidelity guarantee and the some part of the miscellaneous insurance. So we, from yesterday and today, within these 2 days, we have come across the personal accident, the burglary, then the money insurance, the fidelity guarantee. All these types of miscellaneous products we have come across. There are the wide range of miscellaneous products are there, and there may be a liability insurance which is coming under the miscellaneous policy, the motor, the health insurance. All these subjects are coming under the miscellaneous policy. We'll try to have a quick look on many of the things, and whatever possible from my side, I will extend my maximum presentation to you in the coming lectures also. So thank you from my side. Thank you very much, and I wish you all the best. Please keep doing your good studies, keep doing your good work along with your office work, and try to have the good marks in your examination, because your success matters us a lot. Thank you very much. We sum up for today's session here. Thank you.